Digital banks processed $4 trillion in payments last year. Your core system handled what? Exactly. While you were waiting for board approval on that digital initiative, 3 new fintech companies just launched in your market with features your customers didn't even know they wanted. Until now, still waiting for your IT roadmap. By the end of this episode, you'll understand exactly why traditional banks are losing market share faster than ever, and why the institutions that survive will be the ones that stop thinking like banks and start thinking like technology companies that happen to offer financial services. More importantly, you'll see the specific gaps in your current infrastructure that are bleeding customers and revenue right now. I'm Alexandra, and this is the reality check your board probably doesn't want to hear. At Advanedge Consulting, we've spent the last decade helping banks and financial institutions bridge the gap between legacy systems and the fintech revolution. What I'm about to share isn't theory. It's what we see every day in boardrooms across Texas and beyond. Here's what most traditional financial institutions are missing. It's not just about having a mobile app or offering online banking anymore. The problem runs much deeper. It's in the foundation of how banks operate, process transactions, and think about customer relationships. Last month, we worked with a regional bank that was losing commercial customers to a fintech competitor they'd never heard of. This fintech was approving business loans in 48 hours. The bank, 14 business days. On a good week, same creditworthiness, same risk profile, but completely different customer experience. The difference wasn't just speed. It was architectural. The data tells the story. Digital-first financial institutions are capturing 61% of new account openings in the 18 to 34 demographic. But here's what should really concern you. They're now taking 37% of new accounts from customers over 50. Your most loyal demographic is defecting. Why? Because customer expectations have fundamentally shifted. When someone can transfer money instantly through Venmo, get a loan approved through their phone, or invest with zero fees through a robo-advisor, your traditional processes don't just feel slow, they feel broken. Most banks think this is a user interface problem. Better mobile app, slicker website, maybe some chatbots. But that's treating symptoms, not the disease. The real issue is legacy infrastructure that was built for a different era of banking. An institution we recently helped was running critical processes through systems that required manual data entry at 7 different points. 7. In 2024, their loan officers were literally retyping customer information from one system to another. Meanwhile, their fintech competitors were using AI to pre-populate applications and make credit decisions in real time. This isn't about technology for technology's sake. It's about competitive survival. When your back-office operations take days to do what fintech companies do in minutes, you're not just losing efficiency. You're losing revenue. Here's how the fintech revolution is actually reshaping finance, and why traditional banks need to pay attention. It starts with artificial intelligence, but not the way most people think. AI in banking isn't about replacing humans. It's about eliminating the mundane tasks that slow everything down. We've helped institutions implement AI systems that can analyze credit applications, detect fraud patterns, and even predict which customers are likely to refinance elsewhere. One bank we worked with reduced their loan processing time by 73%, not by working faster, but by working smarter. Blockchain technology is creating new possibilities for secure, instant transactions. While many banks are still debating whether cryptocurrency is legitimate, smart institutions are exploring how blockchain can improve their own operations. Cross-border payments that used to take 3 to 5 business days, now happening in minutes with full transparency and lower fees. But here's what's really disrupting the industry. Core banking modernization. The big 3 core providers, Fiserv, Jack Henry, and FIS, serve roughly 70% of U.S. banks. These platforms are powerful, but many institutions are running outdated versions or aren't fully utilizing their capabilities. We regularly find banks using maybe 30% of their core systems functionality. That's like buying a Tesla and only using it to listen to the radio. Modern core banking platforms can integrate seamlessly with digital payment systems, provide real-time analytics, and support the kind of rapid product development that fintech companies use to stay ahead. But integration requires strategy, not just implementation. For lending specifically, institutions that have modernized their loan origination systems are seeing dramatic improvements. Abrigo, for example, has transformed how forward-thinking institutions approach lending workflows. Banks using advanced loan origination systems like Abrigo are making faster, smarter lending decisions while maintaining rigorous compliance standards. It's not just about speed. It's about competing effectively in modern credit markets, where customers expect Amazon-like experiences for financial products. Digital payments are another critical piece. Real-time payment systems, embedded finance, and seamless integration with accounting software aren't nice-to-have features anymore. They're table stakes. Businesses choosing financial partners based on how well their banking integrates with their operations. So what can you actually do about this? What does Advanedge help our clients implement right now to compete effectively? First, comprehensive system audits. Most banks don't actually know what their current infrastructure can and cannot do. We map existing capabilities, identify integration opportunities, and create realistic modernization roadmaps that won't disrupt daily operations. Second, strategic partnerships with fintech companies, instead of viewing them as competition. Some of our most successful client transformations have involved partnering with specialized fintech firms to offer services the bank couldn't develop internally. It's faster, more cost-effective, and reduces risk. Third, regulatory navigation. This is crucial. One reason banks move slowly is legitimate concern about compliance. But regulatory requirements don't have to mean slow implementation. We help institutions modernize while maintaining full compliance with banking regulations. It's possible to be both innovative and compliant. Fourth, staff training and change management. New systems only work if people know how to use them effectively. We've seen expensive technology implementations fail because institutions didn't invest enough in training their teams. Fifth, data analytics implementation. Most banks are sitting on gold mines of customer data but aren't using it strategically. Modern analytics can predict customer needs, identify cross-selling opportunities, and flag potential issues before they become problems. The implementation process typically takes 12 to 18 months for comprehensive modernization. But institutions start seeing results within the first quarter. Improved customer satisfaction scores, faster processing times, reduced operational costs, and most importantly, competitive positioning that actually retains and attracts customers. Here's the bottom line. The future belongs to financial institutions that stop thinking like traditional banks and start thinking like technology companies that provide financial services. That doesn't mean abandoning the trust and stability that banks represent. It means delivering that trust and stability through modern, efficient systems. The institutions that thrive over the next decade will be those that embrace this transformation now, while they still have time to do it strategically rather than reactively. Your competitors already know this. You don't. Yet.